Well, that was a great session. A big thank you to our panelists. Our next panel discussion will explore the implications of ESG regulations and standards on the financial services industry. This session will be moderated by Claudia Gomaya, CFA, Senior Investment Officer, Managing Director from Colchester Global Investors. Claudia manages global and emerging bond portfolios and conducts economic and ESG research. She also chairs the PRI Sovereign Debt Advisory Committee. She's a member of the CFA UK ESG Working Group, which developed the first professional ESG qualification. Claudia will be joined by a distinguished panel of experts. So Claudia, over to you to introduce our panelists. Thank you.
Thank you much, Laura, for the kind introduction. And as I said, I'm very pleased to be joined by three very knowledgeable panelists today, starting with ladies first. Grace Hui was the head of Green Sustainable Finance at the Hong Kong Stock Exchange until January this year. From 2013 to 2019, Grace was the Chief Operating Officer of HKX Listings Division. During her tenure at HKX, among other things, Grace initiated and implemented projects needing to transform the Hong Kong market into a vibrant, green and sustainable financial market. Chase Norman Lee is a managing director at the Legal and Regulatory Division of Temasek. He has more than 20 years of experience providing legal and regulatory advice across different areas in global financial markets. His specialties include complex derivatives, carbon trading, financial regulation, and commodities. And Michael Salvatazio, head of Asia Pacific ESG Solutions, has spent the past decade providing sustainable solutions to investors, banks, corporates, regulators, governments, and academics. Before joining S&P Global Sustainable, he led the Asia Pacific ESG business development team at Truecost and is involved in ESG-focused initiatives, including the ASFI Technical Working Group and the PRI Fixed Income Working Group. Welcome, and thank you very much for joining us today in this very interesting topic. And I have to say, when I was preparing for this panel discussion, I was really interesting to read that so many financial sustainability finance regulation have been developed over the very recent years. And of course, whilst Europe is still leading the sustainability regulation space, the APAC region is moving at a really fast pace as well. What another really interesting observation I found was the regional differences when it came down to the regulatory approaches, how they were used, and how they were, binding. For today's panel discussion, I've tried to group these regulatory frameworks into four broad categories. Starting with the first one is a company disclosure, which you're very familiar, where companies disclosing their ESG footprint. The second one you could think of are the climate risk management and disclosures. These try to ensure that climate risks are being taken into account, particularly for financial institutions, and regulators are really looking at that, like the Bank of England we have seen, but also here in the region, we have seen MAS here in Singapore, as well in Australia, APAC. The investment product disclosure. Disclosure regulation, or SFDR. That is also sort of being looked at by ASIC in Australia on ESG products, but also the CFA Institute has issued its first voluntary global ESG disclosure standards for investment products. And the fourth and last category I would like to address within the panel are the taxonomies. As we all know, that's a framework which tries to find common definitions to define what constitutes really a sustainable investment. We have seen many different approaches here, starting from the EU and into the Asian region. Now with that backdrop, Grace, obviously with your background in the Hong Kong Stock Exchange, starting with the first question to you on company disclosures. Would you be able to share a little bit your experience, how companies have been disclosing their journey, and maybe even comment a little bit more around the APAC region?
Sure, thank you, Claudia. First of all, I would like to thank the CFA Institute for inviting me to the Alpha Summit APAC, and what an incredible turnout of all the online participants. So thank you for your question, Claudia. I think I will start off with the Hong Kong's recent, more stringent rules on the board independence and diversity. And in recent months, there have been a lot of focus on the environment side of ESG, but not near as much on the social or governance side. Without good corporate governance, it is really incredibly difficult to make any meaningful changes to address risks arising from the environment or social aspects. Unlike Europe or the Americas, most of our Hong Kong listed companies are state, family, or founder controlled. As such, there's a greater expectation from investors that minority shareholders' interests are properly considered and safeguarded. And this is the reason why we focus on the independence of independent non-executive directors. Indeed, over the last decade, we have implemented a lot of changes in Hong Kong, including an increase in the minimum of independent directors on the boards to a minimum of 3 and comprises a third of the board. An increase in the minimum cooling off period of previous business relationships to 2 years, introduction of board diversity policy, as well as overboarding concept, such that a public explanation is required for any director holding 7 or more board directorships. Additional disclosures such as the selection or nomination process of independent directors and the diversity of such directors must be brought to the board. The most recent corporate governance amendments, which came into effect earlier this year, again address board independence and diversity. Hong Kong listed companies are now required to have a mechanism to ensure independent views are available to the board. For re-election of independent non-exec directors serving more than 9 years, the so-called long-serving INEDs, additional disclosures would need to be made on why the long-serving INED is still independent and should be re-elected. And if all INEDs on board are long-serving INEDs, a new and additional INED would need to be appointed. The other key changes relate to diversity. A single gender board will no longer be considered as a diverse board, and we will require numerical targets and timelines to be set for achieving gender diversity at board level, and disclosure must be made on gender ratios in the workforce. These changes on gender diversity requirement have attracted a lot of discussions in our market. On the one hand, some argue that directors' appointments should be based on merit. In reality, when we first introduced board diversity policy in 2012 in Hong Kong, women held only about 10% of the total directorships on Hong Kong listed issuers boards. As of 2020, that percentage has increased slightly to around 14%. This slow pace is unacceptable to stern supporters of gender diversity, who are of the view that as an international finance center, Hong Kong has to catch up with other jurisdictions in the region, which have a higher percentage of women directors. For example, in Australia with 32% and Malaysia with 25%. The CFA Institute recently released a comprehensive report on independent directors in Asia Pacific, and I highly recommend any companies wishing to improve its board governance or investors wishing to challenge their investee companies to read the recommendations in that report. Claudia, if I may now turn to other elements on ESG. Finance regulators in Hong Kong have made it very clear on the direction it is moving in relation to ESG reporting. particularly focuses on climate-related disclosures. We were one of the first jurisdictions in the region after New Zealand to incorporate TCFD, Task Force on Climate-Related Financial Disclosures, in our ESG disclosure, and such disclosure will become mandatory by 2025 across all relevant sectors, taking into account the disclosure standard that is being developed by the International Sustainability Standards Board under the International Financial Reporting Standards Foundation. Now, Japan, Taiwan, Singapore have also announced incorporation of TCFD in their disclosure requirements. According to a recent Bloomberg report, Hong Kong has seen the most growth from the average ESG disclosure score of 17 back in 2010 to over 40 in 2020, leading other markets in the APAC region. I believe this has a lot to do with our finance regulators joining hands to signal to the market their expectation on ESG reporting requirements, whether for listed companies, banks, or asset managers. Singapore has also done the same, and I do recommend finance regulators of other jurisdictions to consider if they wish to move the needle on ESG reporting and become one of the green and sustainable finance centers. Finally, I wish to highlight efforts made by other exchanges or agencies very recently. Singapore announced that it will require all directors to undergo a one-time training on sustainability. I think this is a very good idea, as tone from the top is essential when it comes to managing ESG risks. Thailand Stock Exchange has launched their first guidance to assist listed companies to identify, address, and report on modern slavery risks throughout their value chain. And last but not least, SEBI in India announced a regulatory framework on ESG ratings providers. I do see that there will be more rigorous regulations on ESG rating providers in the horizons in general. For example, the EU has already published its consultation in this regard earlier this month, and the US market regulators have also flagged risks for ESG rating providers, such as failing to follow rating methodologies and failure to manage conflicts of interest. I think these are good developments given investors pour record amounts of money into funds that use ESG criteria to select holdings, leading to the rise of rating services aimed at guiding those investments. With that, I don't want to pressure Michael as he's going to come after me, but I will now pass the floor back to Claudia. Thank you.
Thank you, Grace. There's a lot of information in there, and thank you very much for this very comprehensive answer. Well, with that, I'm actually do pass it on to Michael and will ask, what as a service provider, with the regulations having come through recently, what have you seen from your clients? What were the needs you could help them out with? And what also were the biggest pressure points from these regulations your clients have experienced?
Thanks, Claudia. That's the area we spend all of our time working on, is how to understand these regulations and how they apply to different organizations across Asia Pacific. In fact, now my remit includes Central Asia, Middle East, and Africa. So you can imagine there's a large difference of approaches across these countries as to how they're thinking about and applying ESG or climate risk in particular. And what we've heard from Grace is, I think of it as a double-edged sword. There's positives and negatives. I mean, the positives around these regulations is that it's being tailored to a local market, so it applies specifically to that location. The challenges are for global organizations to stay up to date with what's required, and also then from a provider perspective to be able to support our clients with a solution that meets their needs. You can imagine there's a little bit of customization that happens when we're working with clients on specific reporting around ESG or especially climate risk. Overall, that the challenge is reduced because there is an emphasis on climate change through whether it's stock exchanges or regulators, or governments, or even pressure from investors, so from other stakeholders, because climate change has been identified as material risk, and climate change the burden on reporting for climate change has been reduced by TCFD and TCFD alignment. So if you look at where the regulators are, or what the regulators are calling out, it's most often a TCFD aligned climate risk reporting. And that actually assists clients because it helps them understand. It's a framework that's consistent, it's very modular, and it then allows us to work with those clients to understand and identify and especially quantify those risks. So our area of focus when we're speaking to clients, whether it's a corporate or financial institution like a bank or an investor, is, well, you're in the finance space or you're in the accounting space, and numbers are really important to you, and having an understanding of what your exposure is means understanding your current position and being able to quantify it, and then understanding what the future risks are. And so in doing that, we're emphasizing that it's the numbers which are going to be equally as important, if not more important, in the future when it comes to analyzing the reporting from these organizations, because that's what the investors are going to be looking at. And so we're encouraging companies to disclose and on scope 1, scope 2, scope 3, for instance, which is consistent no matter where you are or what regulatory environment you're under. We also say to them that if you're not disclosing it, if you're in an environment where disclosure is guided but not mandatory, then it's going to be modeled anyway, and it's better that you control that with your own reporting. In terms of what else is helping are initiatives like the International Sustainability Standards Board. So that's helping bring reporting aligned. And we also find that clients who work with us on our corporate sustainability assessment understand and appreciate the strategic focus of that data collection and identification of issues, which they then can use in their external reporting, which tends to be, I won't make a bold claim and say it always is, but it tends to be aligned with what exchanges are requiring, even when they're going to the point of mandating those requirements. I'll stop there. Thanks, Claudia.
No, thank you very much. That was very helpful to see all the differences in the regions as well. Jason, I'd like to ask you, as we've heard from Grace and from Michael, as from the service providing side, stock exchange point of view and experiences, what do you think from an asset manager's point of view have these raft of regulations having had an impact and will have future impacts on them, and any good advice for any of these institutions they should think about throughout their sustainability journey?
Thanks, Claudia. Firstly, I want to again say thanks for having me on the panel today. Firstly, I'm just going to take on a theme which was articulated by Michael and Grace previously. APAC is not a monolith jurisdiction. It is made up of many different countries which have different regulatory priorities, and that leads to a fragmented regulatory environment, which regulators have different timelines, priorities, and so on. So that's just to set the scene. Within that, we can see the regulations coming out having impact on AMs and FIs across three pillars. And this is my view. Firstly, in the increased regulations is actually influencing the entire 360 or end-to-end operations of entities, how the governance process is set up, how risk is managed, how portfolios are constructed, and also what sort of disclosures. If you think about it, many of these AMs or FIs have fiduciary duties to their clients and the customers, and that includes the ability to size up risk and to manage that risk. And ESG risk, and more particularly climate change risk, is something which has to be embedded in that. The second point is also on stewardship. I think that's we've seen some of the AMs now engaging more with their investee companies, assisting them in their climate or transition journeys, influencing them with their targets, and trying to share experience and best practices. That's on the AM side. But even on the banking side, and we've seen this with MAS on the environmental guidelines for banks, where there's actually an exhortation for them to engage with their clients who will face significant environmental risk and try to encourage them or move them to a different transition path. So, we see again stewardship being another key theme, and it's not all doom and gloom, because it's also opportunities. There's a whole new field open in terms of ESG investing, and there are some subcategories there: thematic, sustainable, impact, and so on. So we see again, and I was a bit surprised to see the percentage of GSSS bonds as opposed to the overall debt market last year. There's a significant opportunity for asset managers and FIs to market and to sell and to, again, manufacture products which suit this whole new ESG themed investing. So those are the big three pillars, Claudia. But if some practical guidance I would give to AMs that are starting on this journey, or FIs, firstly, and no surprise, as my background as a lawyer, prioritize regulatory compliance, right? That's table stakes, or the base case to conduct business in a safe and sound, and that goes to whatever is required in the jurisdiction in which you do business. Secondly, the transition to, at least from climate or ESG, is going to be a messy and is going to be non-linear. So to the extent that someone is starting on this journey, my advice is actually to, if you got your program in place, is to try and focus on a couple of particular areas, whether it's climate change and so on, and then to build upon it layer by layer. The next step is also to build capability and knowledge, where we see that creating the awareness right from the top to the governance to the middle, back, front office, and so on, is going to be significant to create that awareness, where that's an important component on how people should go about doing their business. And that includes many different things, including training, seminars, and so on, right? The fourth, I would say, is as they move towards this path of incorporating ESG elements into their everyday BAU, to think about situations where they can leverage external service providers who will be able to assist them in their journey in transitioning while they build up their capability, and also to leverage up technology. Again, technology, in my view, functions very much as a force multiplier. When you need to do ESG scanning, you need to do due diligence on your targets or your clients and so on, to try and leverage that to be able to create a program which is scalable. And lastly, which, again, is, I think it's actually reflects something which APAC probably has not been doing so well, is actually to increase your engagement in regulatory developments. Now, we've reached a stage where the regulators are very open to taking comments and with consulting people in the industry and other stakeholders. And I think it's incumbent on the people in the finance industry, AMs and FIs, to actually engage in these discussions, so that what we have produced in terms of regulations which are binding upon the industry reflects a consensus, or actually input from those in the industry. So don't put a ostrich in the sand kind of mentality with the firm, but please engage, and through trade groups or direct engagement with the regulators. I think that's going to be pretty important as we move on this journey. So back to you, Claudia.
Thank you, Jason. I think you'd find in many companies the lawyers and legal departments would be quite happy to prioritize the compliance side of things. So I agree with that. And on the training side, I'd just like to add, don't forget there's the CFA Institute ESG Investing Certificate, which we had developed back in 2018. This is CFA UK and has been taken over now by the CFA Institute and available globally. So thank you very much for that. It's been also quite helpful. Now, Grace, I would like to touch on one of the other 4 topics, I've categorized, and one being taxonomy. In particular, where you're located, you've seen the EU has been working with China on the common ground taxonomy. Could you comment on this one a little bit, but also what other developments you see in relation to a low carbon economy in the APAC region?
Sure, thanks, Claudia. As you said, the common ground taxonomy, it is something that has been developed between the EU and China. There has been some discussion as to how best to find the definition of green and sustainable. So this first publication of the common ground taxonomy back around COP26, it covers the initial phase of the comprehensive exercise of the existing EU and China's green taxonomies for environmentally sustainable investments, including identifying the commonalities and differences in their respective approaches and outcomes. In the first phase, the CGT analyzed 80 activities across 6 sectors of the EU and China taxonomies and ascribed to 5 different scenarios, such as areas with clear overlaps and where EU or China is more stringent. The 6 sectors include agriculture, manufacturing, electricity, water supply, construction, transportation, and so forth. It emphasizes that its goal is not to create a common or a single taxonomy, nor a standard, but rather it provides an evolving tool that will help different actors to understand the types of activities that could be covered under the respective taxonomies, and eventually lower the transboundary costs of green and sustainable investments, and to scale up mobilization of green and sustainable capital internationally. So the CGT aims to be used to improve the comparability and future interoperability of taxonomies around the world. So after the first phase, CGT will consider additional sector, additional environmental objectives, transition considerations, and other eligibility features, such as do no significant harm and minimum standards. Now, Hong Kong finance regulators have also announced back in December 2020 that the city will adopt the CGT when it becomes available. In terms of other key developments driving low carbon economy, I must say it has to be carbon markets in this region. Mainland China and key overseas markets are dedicated to transitioning to a green, low emission and climate resilient economy. And the global carbon market is expected to grow significantly. As an international financial center, Hong Kong is in a great position to play a strategic role as China's gateway and to mobilize capital to facilitate the national carbon neutrality goal. So there are lots and lots of opportunities presented by both the cap and trade carbon market, what people will call the compliance or mandatory carbon market, as well as the voluntary carbon market in the private sectors. Singapore has already set up a carbon exchange and marketplace that aims to scale the voluntary carbon market. China's national carbon market, which began trading in July last year, covered all the high emitters in the power sector, roughly around 2,200 entities. In terms of coverage, it is already twice the size of the EU emissions trading scheme. What I think will happen later on this year, the China National Trading Scheme is likely to cover to 2 more of the remaining 7 sectors. That is the non-ferrous metal and building material sectors. And they will focus also on capacity building and developing carbon trading infrastructure and capabilities across provinces. We're also awaiting more guidance on when China will restart the trading of their domestically certified carbon credits, the so-called CCER, which stands for China Certified Emissions Reduction Certificates. The State Council announced in last November that the Beijing Green Exchange will host the national trading platforms of these CCERs, and that the Beijing Exchange will also be open to global investors. I think that this will be a very important development as more market participants and hopefully more carbon products such as carbon futures and carbon options, they should help a robust carbon price discovery in China. So there's no doubt that for all the finance industry participants on this panel, listening to this panel, that carbon assets will become a new asset class in the finance industry. Real economy companies are expected to buy carbon credits to neutralize their unabated carbon emissions. And likewise, asset managers will also need to start buying carbon credits to neutralize carbon footprint of their investment portfolios. So in terms of how much to buy, when to buy, and what to buy, companies should first consider and start developing their pathway to net zero. And there is a guide freely available on my ex-company, HKEX's stage website. I just want to comment that in developing a net zero guide for companies, I have made sure that it was practical, not just for listed companies or large companies, but any companies around the world. The Net Zero Guide takes companies through the necessary processes to develop an appropriate net zero pathway. This includes identifying resources required to calculate and establish a carbon emission baseline, setting near and long-term carbon emission reduction targets, identifying emission reduction potential, understanding different mitigation strategies to reduce emissions outside of the value chain, as well as understanding different net zero strategies implemented by various industry leaders. With that, back to you, Claudia. Thank you.
Thank you. That was very comprehensive. And I do want to come back to the carbon market at another question, but I want to stay with the taxonomies for a little bit. Especially, I think, Michael, as a service provider, as you explained before, you've seen the various different regional approaches as well. Could you also talk us a little bit through about the different taxonomies within the APAC region? Grace has explained the common ground taxonomy, but what are you seeing within the broader regions?
Yeah, thanks, Claudia, and definitely seeing a lot of activity and focus on taxonomies. Before I jump into that, though, allow me just to say, when Jason was speaking, I was in so much agreement with him because what he was saying is essentially the message that we had in our key trends that will drive the ESG agenda in 2022. And so I really emphasize to people who are listening to pop over to S&P website after this event and just see those trends, because out of that you'll see a focus on ESG skilled corporate boards and government leaders, and I think that was one of the things that really was emphasized in Jason's note. On that same trends to watch, you'll also see credible sustainable debt markets, and that, Claudia, is my segue back to your question, because that sustainable debt markets is linked to the taxonomy. And if we think about, from the perspective of what is the taxonomy, we've got all these countries looking at what China's doing, looking at what Europe's doing. Essentially, the taxonomy is providing a shopping list of activities that can be classified as green. And by green, they promote rapid decarbonisation. They promote a guide for investors and companies to create investments. In other words, to unlock that enormous amount of capital that's sitting there waiting to help decarbonize the planet rapidly, because we're in a climate emergency and we need to reduce emissions quickly. And we're on that pathway. So total sustainable debt issuance reached a record high last year of around 960 billion. So not quite a trillion, but 960 billion. And we can see ourselves in the activity at S&P Global that our second party opinions requested or the business that we were doing in that area almost tripled in 2021 on 2022. So, that SPO is there as a tool to provide protection from greenwashing, if you like, and that's something that's also very connected to the taxonomy. If I come back directly to your question around what's happening in APAC, let's think about it again from, what is it that taxonomies, why are different countries thinking differently about a taxonomy? Why do they need a taxonomy? Why not just use the European one? And if we think about it from the perspective of, well, the taxonomy is providing that common language for investors, issuers, and policymakers, which might make you say, hey, let's just use the EU. But it's also helping, translate the Paris Agreement and the SDGs. And it's putting the environmental data into context. And environmental data is related to that local economy. And so this is why the discussions are happening across Asia Pac around, what do we need in order to have investment come to our country in the way that supports our decarbonisation? And is the EU taxonomy the right approach? Remembering that the taxonomy is focused on specific areas and objectives like climate change mitigation, adaptation, right? These are all important. And remembering that the key here is that investors want to be able to say, hey, we put our money into a company that that is aligned to this taxonomy. Or a company can say, hey, we invested in this project. And we're a company that by our nature is in a segment that is highly polluting, but we've invested in this technology that meets these thresholds for emissions intensity that are below the thresholds outlined in that taxonomy activity. So therefore, this project can be considered to be aligned and therefore green. And that's how we spend our time working with clients around being able to measure those revenues and revenues from companies that are aligned, so that investors and banks can say, yep, we're doing the right thing and it's supported. This is happening across Asia Pac, like I say, these discussions. So I'm working as part of the Green Finance Industry Task Force in Singapore to understand the nuances of the Singapore economy and what kind of taxonomy should apply. It's quite transparent around having consulted the market to look at what taxonomy would work and what activities should be included. I'm also part of the initiative that's happening in Australia, the Australian Sustainable Financial Initiative version 2.0, where one of the key points on the roadmap is to create a taxonomy. And given the discussion that we're having today with the members of that ASFI group, the founding members, is, well, a taxonomy is probably a good place to start, because we need to have that shopping list, which is helping investors see where they can put their money that will allow them to say this is a green sustainable investment and avoid that greenwashing. We're also seeing a recent launch of the ASEAN taxonomy review. So if people haven't seen it, again, that's another thing to be looking at after this conference, because that ASEAN taxonomy review exists. It's a document that's been released. It was released recently, and it's intended as a reference point for sustainable projects and activities in ASEAN to help issuers as well as investors understand the sustainability impact of a project or an economic activity. So it's not only is it in the process of happening, but we're already seeing it happen in Asia.
Thank you very much. Can I just have a follow-on question on this? How, from an investor's point of view, after we have, some taxonomies being done, finding it tricky, anything beyond obviously corporates, but also, in the fixed income space, and private markets, obviously getting even trickier.
Yeah, this is the challenge, Claudia. It's again, I come back to that double-edged sword. It's going to be my theme for this session. You know, having a taxonomy that identifies projects which can rapidly decarbonize your economy, because the Singapore economy looks very different from the Australian economy, looks very different from the Japanese and the Chinese, right? So they all need investments in different areas. But you've got global investors and you've got an enormous amount of money sitting in Europe, for instance. In fact, I was having a chat with a fixed income investor today, and his perspective was there's this enormous amount of capital sitting in Europe, which is going to need to report against SFDR. And so they're going to have to be putting their money somewhere that they want to make it easy. They're going to be putting their money into those projects which are easily recognizable within the taxonomy. So does that mean that if you have a taxonomy in Singapore or Australia, or that's very different from the EU taxonomy, does that mean that European investor is hesitant, even though the project might tick the box? It might be profitable, it might achieve their strategic objectives, it's aligned with a taxonomy, but at the same time, the challenge for them is going to be to explain to their chief financial officer, their stakeholders, their investors, that hey, yes, I know this doesn't look as doesn't fit within the EU taxonomy, but it's green because it meets this criteria in this taxonomy.
Yeah, that's very helpful, because I've been working with the Inter-American Development Bank developing the Green Bond Transparency Platform. As for investors, it's obviously, being on the other side, from the issuer side, it's very difficult to get then those matrices. How much has been funded? What has it been applied to? The aftermath when it comes to the reporting side. So that I totally agree with what you're saying there as well. We could
hopefully that's our job, to make it easier in the long run. Right? We'll do the work to make it easier for those investors to be able to report.
Exactly. So look forward to that. We could obviously talk a lot more about taxonomy, but very conscious of time here. And I did say I want to come back to this carbon market as well. Jason, could I ask you your thoughts on the carbon market? As you mentioned earlier, it's an important aspect too.
Yeah, thanks, Claudia. So we've looked at the carbon markets themselves. There's the two branches, the voluntary carbon markets and then the compliance market. Although you see from COP26 with ITMOs coming out, there could be some sort of linkages in future. But just broadly, if you think about it, the carbon markets is essentially one option to put a price on carbon, besides a carbon tax, right? So you have these two different aspects on compliance markets and on voluntary carbon markets. The key thing for me when I look at it, and we could spend the whole day talking about it, or perhaps even longer, but I'll just take up some of the key points which I see on the ETS or emissions trading schemes we have. One, again, is the scope on which the industries are supposed to cover. As Grace mentioned, in China, they started off with a particular segment and are looking to expand it. So how these schemes are designed is going to be critical. The next point there is also any sort of shock absorbers which are imposed into those schemes, whether a price floor or a price cap, which actually functions as an interference in the free flow of the market. There could be policy reasons to do it. But my message there again for these ETS is the design is actually going to be pretty important as Asia itself rolls out. I think probably you have 4 or 5 jurisdictions in APAC which have ETS. When more jurisdictions come out, that's going to be key to think about the design. So that's one. Well, in the voluntary carbon markets, again, there's so many different issues here. One of the things is we hear is that, this market needs to be regulated, right? Now, again, I would say first people should think about it and be a bit more thoughtful on what aspects need to be regulated. If you look at the entire value chain for VCMs, right, that goes from the project itself to standards, verification, trading, and so on. It's a long chain. And actually, at Pickup, when people talk about regulation, exactly which part of that chain needs to be regulated. And also bearing in mind, there's different elements of that which are already regulated. So for example, if you put a future over NGOs, for example. Those are actually regulated because you're doing it on a regulated exchange, right? So again, I think that we should be a bit thoughtful on how we shape that market. Just two additional points there. What we've done, we've seen, I beg your pardon, what we've seen is that international standard setters, the TSVCM now moved on to the Integrity Council of ECMs, is spending a lot of time coming up with the core carbon principles to see what actually is a good carbon credit. So I think that's a step in the right direction in terms of trying to establish a base case. And then the second point I also mentioned is, again, coming up from COP26, and something to think about is the ability to have VCMs or carbon credits from the offset markets being a source of credits which could be stranded into the compliance market. So I think that's another area where we'll see some movement forward. So again, to summarize, the carbon markets too, to think about the ETS, you really need to think about the design if you're setting that up, and also on the VCM market itself, and just be very thoughtful on which parts of it need to be regulated and when. And I can say that again, some of the standard setters now, the trade associations are beginning to make progress in trying to get to create some industry-led standards would be useful. Just on the last bit of it, and goes back again to data. Data again can't be separated from the carbon markets. And as Grace mentioned, there are various jurisdictions here in APAC that are beginning to look at ESG data providers and so on. And this again, as people recognize, is something which IOSCO put out a very well-written paper at the end of last year, looking at ratings and data, which is going to be a key component to drive the carbon markets. Gotcha.
Thank you for that. You actually already answered parts of a question which had come in. And one of them, do you think it is necessary to regulate the voluntary carbon market? So you pretty much answered quite a lot of that. Is there anyone else from the panel who would like to talk a bit more about the carbon market? That's okay.
I think, Claudia, I absolutely agree with everything Jason just said. I think, for this region, we are starting to have a lot of discussions around the carbon market, and there are a lot of education that need to take place in relation to increasing, the participation by companies and other market participants in both the voluntary and also the compliance carbon markets. I think for the voluntary carbon market, I think in the past, a lot of the carbon credits are not fungible, and also there's been fraud and integrity issues. So I agree with Jason. There's been a lot of work done by the Integrity Council, and setting a baseline. It is really important. My concern is more, in the future, when this market is going to grow to, 50 to 100 billion, estimates that I've seen by 2030. With such a, big size of a market, I think there needs to be some sort of regulations in relation to, certification of the high quality or high integrity of these carbon credits, and to make sure that that everybody taking part in the whole process are true and honest.
Can I just add there, Claudia, two things? One on pricing carbon credits, carbon units, and the other on that quality assessment or rating or review of the carbon units. So on the pricing side, we've been pricing, benchmark pricing carbon units, different types of carbon credits over the period of the last year, and we released those benchmark prices last year. They were some of the first, and we were able to identify, for instance, the Corsia carbon price was up almost 1,000% in less than a 12-month period. But these carbon price benchmarks, like our commodity benchmarks, can be used then for a futures or a derivatives market. So there's huge potential for the carbon market to expand into the other areas that we see in financial markets. And that brings risks as well. So with those risks, we need greater regulation or greater review or greater standard setting. And the standard setting that exists today has provided a platform for a review that has been there since the start. It's been created by the people involved. I think there is a place definitely for an organization like S&P, which has that background in ratings, to apply similar assessments to those carbon projects in order to give buyers more confidence, especially when those carbon units form such a big part of their net zero commitment. They don't want that reputational risk from having bought a credit that actually represents a project that doesn't exist or falls over or burns down.
Thank you very much. That's been extremely helpful. And, there's so many more questions obviously on carbon, all the other topics we could talk about. One last one I just want to mention on the standardization and transparency, which all three of you had mentioned, how important it is in all aspects of, is it on the product side, is it on a approaches. And I think that's also important why the CFA Institute has developed the first global ESG disclosure standards for investment products, which is another area which we haven't even really gotten to speak about, which also needs, transparency and regulation or standardization. And I think it's not the first standard the Institute has developed in terms of transparency, but it's a difference to that one compared to the previous ones, that it actually covers all approaches within ESG. It covers all asset classes, all investment vehicles, and all markets as well. And on top of it, to managers' disclosures can be independently assured as well. So that's an additional difference. If anyone wants to have more information on that disclosure, please reach out to the CFA Institute and have a look at it. Now, unfortunately, I'm being told time is coming really to an end. I really enjoyed that, and it's a topic we could talk for hours. Thank you so much to all the three panelists, Grace, Jason, and Michael, and to the audience. Thank you very much. Back to you, Laura.
Thank you.
Thank you so much, Claudia, and our panelists. I think you would agree with me that there is a lot of food for thought. Well, we shall now take a short break and come back for the next panel discussion. Just a reminder once again that the virtual rooms are open. Please do take a minute to visit them. We'll see you back shortly.
Our flagship index, Hang Seng Index, was launched more than 50 years ago and is the leading benchmark for investors to gauge the performance of the Hong Kong stock market. Being a leading index compiler, we are currently having over 1,400 indexes covering both Hong Kong and onshore China Asian markets. We are committed to striving for excellence and will continue to enrich our index solutions to meet with different investors' demand on thematic, ESG, and smart beta indexes.
At the recent COP26, world leaders are determined to tackle climate risk and promote sustainable investing. Hang Seng Index's companies are committed to addressing the growing demand of ESG investing. Recently, we have launched 2 new ESG indexes, the HSI ESG Enhanced Index and the HSI Low Carbon Index. These 2 new indexes serve as valuable basis for investment products with lower ESG or carbon exposure focus.